A London bank's bad bet on Argentina nearly triggered a worldwide financial collapse, and almost nobody saw it coming. On November 8, 1890, Barings Bank, one of the oldest and most trusted financial institutions in the world, discovered a problem that would reshape how the global economy works. It loaned enormous sums to Argentina. The money was supposed to finance railroads, government bonds, and infrastructure. And here's the trick: nobody outside the bank's inner circle knew how much exposure they actually had. The public still believed Barings was invincible. Exhibit 1: The scale of the problem. Barings had lent roughly £21 million to Argentine ventures, a staggering sum for 1890. To put that in perspective, the bank's own capital was only about £3 million. They'd bet the entire institution on a single country, and that country was in trouble. Argentina in the 1880s looked like a sure thing. The country was booming, railroads were expanding, land values were climbing, European investors were pouring capital in, and Barings positioned itself as the gateway. But the boom wasn't built on production, it was built on borrowed money and inflated land prices. And when the price of wheat, Argentina's main export, began to slip, the entire structure started to crack. Exhibit 2: The cascade of defaults. In 1889, Argentine companies began defaulting on their loans. The government couldn't service its debt. Barings was holding the bag, literally millions in paper assets that were becoming worthless by the week, and the bank couldn't sell them. Who would buy Argentine debt when everyone knew Argentina was sinking? The real danger wasn't Barings alone. Barings was the hub of a vast web. They'd borrowed heavily from other banks to fund the Argentine bets. They'd sold shares of the debt to investors across Europe. They were the counterparty in countless contracts. When word started to leak that Barings was in trouble, the entire system began to seize up. Exhibit 3: The run. By November 1890, Barings' customers and creditors knew something was catastrophically wrong. They began withdrawing deposits. They demanded cash. The bank couldn't meet the demands. Their money was locked up in Argentine paper. Without fresh capital, Barings would collapse within days. Here's where the system almost broke. If Barings failed, every bank connected to them faced massive losses. Creditors who'd lent to Barings would go under. Investors who'd bought their debt would be wiped out. Banks in other countries that had deals with Barings would face sudden, unexpected holes in their balance sheets. This wasn't a single bank's problem anymore. This was contagion. Exhibit 4: The intervention. The Bank of England stepped in. On November 10, 1890, just 2 days after Barings admitted the crisis, the Bank of England coordinated a rescue. It wasn't a bailout in the modern sense. There were no government funds. Instead, the Bank of England organized a consortium of other banks and wealthy merchants to guarantee Barings' liabilities. The rescue required about £17.6 million raised by private banks, not the government. These banks agreed to back Barings' debts to prevent the system from collapsing. And here's the trick: they weren't being charitable. They were protecting themselves. A global financial meltdown would have destroyed them too. Exhibit 5: The aftermath. Barings didn't disappear, it was restructured and eventually recovered, but the crisis exposed something fundamental about how the global economy worked. A single institution's bad decisions could trigger a cascade that threatened every other institution. The risks weren't isolated, they were systemic. The 1893 Barings crisis proved that interconnectedness was a double-edged sword. Banks could move capital across borders with unprecedented speed. Capital could flow into emerging markets like Argentina. But when things went wrong, the losses flowed back just as fast. There was no circuit breaker, no pause button. Regulators started to ask hard questions after Barings. How much could banks borrow? What collateral was acceptable? Who was responsible for monitoring systemic risk? These weren't abstract questions, they were about survival. The answers they came up with shaped banking regulation for decades. Exhibit 6: The lasting lesson. Before Barings, many assumed that old, prestigious institutions were too big to fail because they were too important. The crisis proved that wasn't true. Size and reputation didn't protect you from bad leverage and concentration risk. A bank could be 200 years old and still collapse in days if the fundamentals were wrong. The Barings crisis happened because of opacity. Barings' true exposure was hidden. The counterparty risks were invisible to most market participants. Information traveled slowly, by ship, by telegraph, by letter. By the time the crisis was public, it was already critical. And here's the trick: the modern financial system wasn't built to prevent crises, it was built to contain them. After Barings, central banks became lenders of last resort. They would step in, as the Bank of England did, to prevent systemic collapse. The assumption was that private institutions couldn't be trusted to self-regulate. That principle, central bank intervention to prevent systemic collapse, became the foundation of modern finance. It appeared again in 1929 and 2008, and in every crisis since. The Barings crisis didn't just reshape banking in the 1890s. It wrote the playbook for how the world would respond to financial emergencies for the next 130 years. The Barings crisis nearly triggered a global financial collapse because one institution had bet too much on one country, hidden the extent of its exposure, and became too interconnected to fail safely. The system survived barely, but only because other banks and central authorities were willing to absorb the losses to prevent contagion. That's not a sign of strength. It's a sign of fragility masked by coordination. This video is for educational and informational purposes only and is not financial advice. Always do your own research. Subscribe for deep dives into the hidden mechanics of money, markets, and the crises that reshape how the world works. This video is for educational and informational purposes only and is not financial advice. Always do your own research.